Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Spectrum Brands Holdings Inc. quarterly report. Spectrum Brands Holdings Inc. offers a diverse range of businesses and services across various segments. The company's home and personal care segment provides home appliances under several brands, including Black & Decker, Russell Hobbs, and George Foreman. It also offers personal care products under the Remington brand. The global pet care segment is another significant business area for Spectrum Brands Holdings, Inc. This segment caters to pet owners by providing a wide range of products, including rawhide chews, dog and cat food, grooming products, and aquarium kits. The company's brands in this segment include Good & Fun, Dreambone, IAMS, EUKNUBA, Nature's Miracle, FU Reminator, and Tetra. In addition to these segments, the Home and Garden segment offers outdoor insect and weed control solutions under the Spectracide brand. It also provides household pest control solutions under Hot Shot and Black Flag brands, as well as personal use pesticides and insect repellent products under Cutter and Repel brands. The company's Rejuvenate brand is known for its household surface cleaning, maintenance, and restoration products. Overall, Spectrum Brands Holdings, Inc. operates through three segments: home and personal care, global pet care, and home and garden. Its diverse range of businesses and services caters to various needs of consumers, making it a prominent player in the consumer products market. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what might cause a company's stock price to remain stagnant over a period of time. The stability of a company's stock price is often influenced by various factors that can either positively or negatively impact its value. One reason for a lack of significant change in Spectrum Brands Holdings, Inc.'s stock price may be the company's consistent financial performance. If the company has been able to maintain steady revenue growth and profitability over the past year, investors may not see a compelling reason to buy or sell shares. Another possible explanation is that the company operates in a mature industry with limited opportunities for significant growth. In such cases, the stock price may remain stable as investors become accustomed to the company's predictable performance. Additionally, external factors such as changes in consumer behavior, regulatory policies, or global economic trends can also impact a company's stock price. Furthermore, the lack of significant news or events surrounding the company may contribute to its stagnant stock price. If there are no major announcements or developments that would typically drive up or down the stock price, investors may not see any reason to react. In conclusion, a combination of these factors could be responsible for Spectrum Brands Holdings, Inc.'s stable stock price over the past year. Spectrum Brands Holdings, Inc. maintains a market capitalization of $2 billion, broadly in line with the industry peer group. Spectrum Brands Holdings, Inc. trades at a lower price-to-earnings ratio of 18 times and a lower price-to-book ratio of 0.93 times relative within the industry. This suggests a potential market detachment, as Spectrum Brands Holdings, Inc. trades at discounted levels while the broader industry remains fairly valued, warranting deeper fundamental analysis. Now, the company maintains a moderate leverage profile, with liabilities making up 43% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has aggressively reduced its share count by more than 5%, indicating a strong shareholder-focused capital allocation approach. The company have a dividend yield of 2.48%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in a company can be attributed to several key factors. On the positive side, the GPC segment has seen significant growth, with an 8.3% increase in net sales, driven by organic growth of 5.8%. Similarly, global pet care has also experienced growth, with an 8.3% increase in net sales. However, not all segments have been as fortunate. The H&G segment has seen a decline of 19.8%, primarily due to lower volumes resulting from earlier seasonal orders and strategic pull forward of orders. The HPC segment has also declined by 7.6%, with organic net sales decreasing by 11.1%. Furthermore, revenue in the EMEA, LATAM, and APAC regions have decreased by $2.9 million, $1.4 million, and $2.9 million respectively. Other factors that have impacted revenue growth or decline include increased costs due to U.S. tariffs, which have pressured profit margins. Additionally, strategic transactions such as the HHI divestiture and HPC separation initiatives have also had a negative impact on revenue. On the other hand, operational efficiencies such as optimizing production processes, reducing waste, and leveraging technology to enhance productivity have contributed positively to revenue growth. The net income of the company underwent a significant fluctuation in the given period. Initially, it increased by 19% from $23.8 million to $28.4 million, indicating a positive trend. However, this growth was short-lived, as the net income plummeted by 92% to $15.3 million, resulting in a substantial decline. The profit margins also experienced changes during this period. The gross profit margin decreased from 36.9% to 35.7%, while the operating income margin dropped from 6.3% to 4%. On the other hand, the net income margin increased from 3.4% to 4.1%. Furthermore, the adjusted EBITDA margins of various segments, such as Global Pet Care and Home and Garden, witnessed a decline. The reasons behind these changes can be attributed to several factors. The introduction of incremental U.S. tariffs on imported goods due to trade policy changes had a significant impact on the company's costs. Additionally, increased expenses for sourced products, materials, and components contributed to the decline in profit margins. These external factors led to a substantial decrease in net income and profit margins, affecting the overall financial performance of the company. The company's financial performance has shown a significant improvement in recent years. One key indicator of this growth is the generation of positive operating cash flow. According to the latest available data, as of December 28, 2025, the company reported an operating cash inflow of $123,100,000, page 5. This substantial amount indicates that the company's core operations are generating sufficient funds to cover its expenses and invest in growth initiatives. Furthermore, another metric supports this positive trend. The company's net operating cash flow for the same period was recorded at $67,700,000, page 32. While this figure is lower than the initial reported amount, it still reflects a significant increase in the company's ability to generate cash from its core operations. Overall, these numbers suggest that the company is successfully managing its finances and generating positive operating cash flow, which is a crucial indicator of long-term sustainability and growth potential. The company's financial health has undergone significant changes over the past year. A notable increase in debt levels is evident from the data provided. The total debt has risen by approximately $2.5 million to reach $581.4 million, while long-term debt has increased by around $1.9 million to $556.2 million. Additionally, obligations under finance leases have also seen a rise of about $2.5 million to $85.3 million. The increase in debt levels is accompanied by a corresponding rise in interest expenses. The company's interest expense for the period ending December 28, 2025, has increased by $600,000 or 9.7% compared to the previous year. This significant jump in interest expenses suggests that the company may be facing higher borrowing costs due to its increased debt levels. The financial performance of various segments and regions has been analyzed, revealing both positive and negative trends. In terms of segments, the GPC segment performed well, with a revenue growth of $15.2 million or 5.8%. On the other hand, the H&G segment struggled, experiencing a decline in revenue of $18.2 million or minus 19% compared to the previous year. The HPC segment also saw a decline in net sales, although the exact percentage is not specified. Regionally, the LATAM region showed improvement, with a revenue increase from $43.7 million in 2024 to $55.2 million in 2025. In contrast, the NA region experienced a decline in revenue of minus $12.2 million or minus 3.2%, although this figure is not explicitly stated. The EMEA and APAC regions had revenues of $200 and $47.2 million and $24.1 million respectively, but no growth or decline figures are provided for these regions. Overall, the GPC segment and LATAM region were the standout performers, while the H and G segment and NA region struggled with declining revenue. Management is optimistic about the company's future prospects despite the challenges posed by U.S. tariffs. Through effective pricing adjustments, cost management, and supply chain diversification, the company has successfully mitigated the impact of these tariffs. As a result, management expects cash flows from operations to be sufficient to meet operating and capital expenditure requirements for at least the next 12 months. Management plans to leverage this strong financial position to pursue strategic growth opportunities, while also returning value to shareholders through a robust capital structure and cash flow from operations. This indicates that the company is committed to both short-term stability and long-term growth, positioning itself for continued success in an evolving market landscape. The company has undergone significant changes through acquisitions and divestitures. Notably, there have been no acquisitions reported. On the other hand, several divestitures have taken place or are in progress. One major divestiture is the separation of the home and personal care business to create an independent global appliances business. This move aims to establish a pure-play consumer products company composed of global pet care and home and garden businesses. Additionally, the company has completed the divestiture of HHI, which was finalized in June 2025. Furthermore, strategic separation initiatives are ongoing for the HPC segment, although no completion date has been mentioned. These efforts demonstrate the company's commitment to streamlining its operations and focusing on core business areas. The company has demonstrated its commitment to returning value to shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid out $0.47 per share for 2 consecutive periods, totaling $0.94 per share over a 6-month period. This consistent payout indicates a stable financial position and a willingness to reward investors. In addition to dividend payments, the company has also engaged in significant share buybacks. Over the past year, the company spent a total of $108.4 million on share repurchases, with 0.6 million shares being bought back at a cost of $35.5 million in 1 quarter alone. Furthermore, the company authorized a $500 million common stock repurchase program in May 2024, demonstrating its commitment to returning value to shareholders through this means. Concerns about inventory buildup or supply chain disruption are evident in the company's operations. Inventory buildup is a concern due to decreased net sales and adjusted EBITDA margin in certain segments, such as home and garden and home and personal care, which have seen earlier seasonal orders pulled forward by retail customers. This has led to lower volumes in these segments, resulting in reduced investment in working capital. Supply chain disruption is also a concern, particularly due to the impact of U.S. tariffs and the global macroeconomic environment on products imported from Southeast Asia and China. The global pet care segment has experienced lower dog and cat food volumes, which may indicate supply chain disruption. Furthermore, shipping large quantities of products ahead of peak consumer buying season can strain cash flow demands, adding to the concerns about supply chain disruption. That concludes the financial summary for Spectrum Brands Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.